global financial crisis has shaken our economy to its foundations, and all across Britain we're feeling the impact. Bills are rising fast, jobs are disappearing, and house prices are falling. So, how did we get into this mess? Tonight, in the second part of our investigation into Credit Crash Britain, I'll be finding out how the borrowing boom came to an end, why the credit's dried up, and asking, can we survive without easy money? As our debts reach record levels, we're now counting the cost of a decade of laid-back lending.
How could we have been so stupid? How could we have not realised that some of this lending was just dumb and was always going to go wrong?
Now the banks are hoarding their money, and years of high living have come to an end.
For the time being, at least, the nice decade is behind us.
When the historians look back, they'll see a society whose lifestyle was really subsidised by money that was far too cheap.
As mortgage and loan defaults soar, the future for many of us looks bleak.
We don't have a life. We have no money to pay for things. We can't go out. We live on basic food rations. We have no money to spend.
As the banks stop lending, how will you cope now the cheap credit has dried up?
Meltdown on the markets, and the crisis is far from over. There are warnings that more companies in the US and around the world may
Billions lost, banks collapsing, and government bailouts. In the last few weeks, not just our economy, but the whole system of global capital has been shaken to its foundations.
Death, it's like a massive earthquake.
Markets have fallen here and around the world.
So in the last 24 hours, a sharp fall in shares on Wall Street led to declines across Asia and then into Europe.
The warning signs of impending disaster started 15 months ago when the banks tried to stem huge losses on the US housing market. The first credit crunch casualty was mortgage giant Northern Rock. The aftershocks of this financial earthquake are still being felt around the world, and some of the biggest names in banking have crumbled. Over the last few weeks, the future of HBOS, the mortgage market leader, has been hanging in the balance. As chaos spreads throughout the financial system, one thing is certain: the credit crunch promises to have an even bigger impact on all of our lives. Faced with chaos in the financial system, banks are now more reluctant than ever to lend money. For many of us, that means the end of a decade of cheap and easy credit. For some, though, it's more than the end of an era. It's the end to a way of life. Unable to keep up with his debt repayments, Bruce Eyre is finally admitting defeat. His home, along with 45,000 others this year, is about to be repossessed by the bank. Before he hands over the keys, it's time for one final look round.
The garden, yes, we will miss the garden. The property, bricks and mortar, you can move on from that. But I think it's the time and effort that we actually put together to get these things growing that is thing which we are going to miss.
As well as falling into arrears on his mortgage, Bruce also has over £60,000 of credit card debts. He's decided to start afresh by declaring himself bankrupt.
We've now gone on to a completely different way of life, one which is taking a bit of getting used to, one where you actually have to have the money in your hand before you actually get something. Now we've moved to the stage where if we haven't got the money, we can't have something.
Since the credit crunch began, interest payments on mortgages, loans and credit cards have soared by £94 billion. As a result, every 5 minutes, someone is going bankrupt. As personal insolvencies rise, business is booming for auction houses. Here in Nottingham, many of the lots I saw going under the hammer were from bankruptcies, and one promised to be the bargain of the day. So what's the story behind this?
Again, this is another personal bankruptcy, Max, from a lady who was only too willing to give us this vehicle. She wanted to end a particular chapter in her life.
New, this is a sort of £55,000 car, isn't it?
Correct. However, it may generate 13 or 14,000. There's no reserve, it will have to sell, and again, all the proceeds will go towards that particular case.
It's got a smashed screen. Do most things come to you in bad condition then, because people don't have the money?
Correct, and they've been trying everything they can in order to pay off their creditors, so you will find that the tyres may be worn because they have no money to be able to replace these items that do need replacing. And this is typical of bankrupt items.
It's not just assets from bankruptcies being auctioned today, there's also the fallout from business insolvencies and the latest gadgets that high street retailers just can't flog. But just how much interest will the day's star lot attract?
Remember, ladies and gents, on this vehicle again, it's another bankruptcy, £50,000 car, £10,000 to start the bidding. Nobody wants it for £10,000, ladies and gents. It's got to sell, there's no reserve. 5 for the Porsche. 5,000. This is going to sell today. 5,000. 6 I have. 7 here. 8. 9 I have. 9,000 for this Porsche. You're looking, ladies and gents. 10,000 we have. We're all finished. I'll take 200 if it helps. All 10,200 here. All done it. 10,200. This gentleman here, number 15, thank you.
Somebody went bankrupt and has sold this car, so in a way you're profiting out of them going bankrupt.
Unfortunately. That's what happens. It's credit crunch now, so a lot of companies go bankrupt, so that's why it's a good time for buyers now.
But for you, you're saving money in the credit crunch.
Exactly. Lucky me, but someone unlucky. Thank you very much and goodbye.
For some, the credit crunch may be a time for killer deals, but many more are struggling beneath the burden of borrowing. This year, consumer debt topped £1.4 trillion, more than the entire GDP of the country and also the highest in Europe. So how did we become so addicted to credit? To find out, we need to turn back the clock. In the old days, to get a loan, to get some money, you had to use your shoe leather and come and visit banks in the high street. Of course, all that's changed, because this bank is now a boozer. Hi Chris, how are you?
Good, thanks. How are you, Max?
Good, thank you. Hello, can I have a pint of bitter, please? Today, the atmosphere may be relaxed, but when this place was a bank, an appointment to visit your manager could be a terrifying experience. So, what qualifications would I have needed to get my hands on a loan?
You'd probably have to know your bank manager pretty well. You'd certainly have to have a record of the savings at that bank so that he, and it almost certainly would be a he, would understand exactly your income and your outgoings and your circumstances.
If you could tell me just a few details, just to put me fully in the picture now.
I want to give you more time to show how prudent and not profligate you were, and you'd have to go and persuade him that you were the sort of person that would deserve a mortgage.
So that means that we shall be wanting £20,000 pretty quickly, or you'll be needing £20,000 pretty quickly.
In the 1980s, many banking regulations were swept away, and with them went the bank manager's conservative approach to lending.
Suddenly you could go to any bank. You wouldn't have to necessarily have your savings there if you wanted a loan or mortgage, because the market was much, much more competitive.
As traditional bank managers shed their stuffy image, many building societies were demutualised, changing from places to stash your savings to PLCs driven by profit. At the same time, the credit card industry was going through a revolution of its own.
That's all right, money. I've got it. It's much quicker with me.
I say, steady on.
And I'm
Market leaders like Barclaycard and Access sold themselves as a convenient form of credit when abroad.
I seem to be getting out of their depth. Access, your flexible friend.
A credit card was really your get-out-of-jail card. It was your in case of emergencies. It was there if you were on holiday abroad. It was also a safe way to buy things.
In the mid-90s, American companies like Capital One and MBNA invaded Britain, determined to change our attitude to plastic.
I hope you didn't put all those on the credit card.
Yeah, why?
Do you know what that could do to us?
The US companies really challenged a lot of what existed in the UK credit card market at the time. There were things like annual fees in the UK, which became under pressure. It was also, they changed the practice in terms of the way these cards were marketed, and they were a lot more aggressive in terms of direct mail.
Don't worry, I used our new Capital One Platinum card.
The Americans targeted a new kind of borrower, the low-risk revolver.
A low-risk revolver is really a credit card company's ideal customer. People who are prepared to have a balance on their credit card for a long period of time, but pay back perhaps the minimum, so they never default, but they're always earning interest for the credit card company.
By 2000, fueled by innovations like the 0% balance transfer, borrowing on plastic had surged to a record £81 billion. Bruce Eyre from Wiltshire was one of the millions targeted by credit card companies trying to expand their market share. The credit card companies found you quite attractive then, didn't they? They kept on offering you cards.
Yes, definitely. Applied for 4 credit cards and maxed them out.
Maxed out, so you spent them to their limit?
Yes, maxing out is just a term where you spend up to the maximum amount of money that you're allowed on a specific card, and then you go on to the next one, do the next one.
At the time, did it seem a bit daft just to borrow to keep on paying off other credit cards to borrow again?
Given the credit that was advanced to me on the basis that the property that I was living in at the time was increasing in value continuously, so I thought, well, the worst comes to the worst, I'll sell the property, get rid of the debts. That was the way that I looked at it.
By the beginning of the decade, property prices were rising by 30% a year, keeping Bruce and millions of others afloat. Anne Ingleby and Nick Haywood from Worthing were also swept along by the credit card craze. When Anne first started using plastic, she was a single mother living on income support.
It wasn't enough to pay everything that you needed. It wasn't enough for the food and the nappies and everything else that you need. And it was very, very hard. So the credit cards came in very useful.
Despite being on benefits, Anne was given more cards and her debts began to build.
I had no problems getting credit. Whenever I came to the maximum on my credit card, they would just very kindly send me a letter saying, we've increased your limit. And I would hope that I would never have to use it, but unfortunately, you do.
Faced with £4,000 worth of credit card debts, Anne took out a loan to reduce her interest payments.
When I took out the consolidated loan, I did pay off all my credit cards, and that felt really great. It felt that I've only got one loan. But then life gets in the way again, and you start using the credit cards. You just don't have enough money when you're on income support to actually survive.
Like many others, Anne was no longer using her cards as a stopgap, but as a way of making ends meet.
The design of credit card product had changed essentially to become a flexible loan product rather than a way of paying for things that you could already afford. It was a way of paying for things that you couldn't actually afford.
Britain was falling in love with borrowing, but for the Bank of England, concern about spiralling debt was overtaken by 2 events of global significance. 9/11 and the bursting of the dot-com bubble raised fears of a major economic depression. To ward off this threat, the bank took decisive action.
The Bank of England cuts interest rates to the lowest level for nearly half a century. The new governor has made a dramatic start. The base rate is now 3.5%.
And for customers, it did something that was quite remarkable. It made borrowing money, particularly for mortgages, extremely cheap. And so you saw the volume of lending rise very, very quickly. And banks, because they were competitive in a very competitive industry, were more than happy to meet this demand.
By making borrowing cheaper and cheaper, the Bank of England hoped to avoid a recession, but at the risk of unleashing forces beyond its control.
Confronted with what we saw, we knew that we were having to stimulate consumer spending. We knew we pushed it up to levels which couldn't possibly be sustained. That pushed up house prices. It increased household debt. My legacy to my successors has been, sort this out.
As interest rates plummeted, credit card companies dreamt up new devices to get us to spend on the never-never.
We saw credit card checks evolving in this period, cashback offers, new reward schemes as well, and they were all really designed to do the same thing, which is to encourage you to use their card and to spend more on that card.
As those nice banks and credit card companies were trying so hard to lend us money at cheaper and cheaper interest rates, well, it seemed rude not to say yes. Buoyed by rising house prices and armed with a little plastic card, Britain went on a spending splurge. During this period, we splashed out £38 billion on fashion, and spending on long-haul holidays rose by an astonishing 41% to £8 billion. By 2005, Britain's craving for cheap credit had become an addiction.
BBC Radio 4, it's 6 o'clock. The Bank of England has warned that rising credit card debt could be a threat to the economy. There's already been a sharp increase in the rate at which lenders are writing off consumer debt.
Despite already consolidating her debts, Anne Ingleby was still spending more on her credit cards. Her new partner Nick realised she was in trouble.
When the phone would ring, she would always dash to answer the phone and then end up hanging up, things like that. And it was obviously people phoning about debt she was in.
It never feels good owing money. When the letters used to come through the door, I felt physically sick. I opened them and just cried, and I didn't know what to do, became very depressed.
To help make ends meet, Nick started borrowing on credit cards as well. Before long, he was in as much debt as Anne.
Just unbelievable how quickly these credit card people just increase your limits. If it's only £1,000, you can cope with it. When it gets up to £10,000 on this card and £10,000 on that card, before you know where you are, you're paying off all the interest, minimum payments, and every month it's going up and you're not spending any money on it.
For Bruce Eyre, rising house prices provided an excuse to take on more debt. A holiday to South Africa costing £8,000 was paid for with plastic.
The holidays that we've had over that period is where a substantial amount of the credit card money went. It was the only way that we could pay it, but it was there. Money was easy to get hold of to pay for these holidays.
Did you really not think about it when you handed over the credit card for various purchases? Did you not think, that's not real, that's not my money?
No, because the culture of the credit card availability is such that they virtually throw the money at you. And if they're prepared to do it, then they should be prepared for you to spend it. I mean, that's the way that, that's the wrong way to look at it, but it's the way that the majority of people who've got credit cards and have got a lot of credit cards look at it. Well, if somebody's going to give us the money, we'll spend it.
After remortgaging his house, Bruce took out loans to pay off his credit cards. His debts escalated. So how much do you think you borrowed on credit cards in total?
The total owed was £62,000 on the credit cards, and that was in addition to the £100,000 mortgage and the £120,000 on the secured loan. So it's a total of about £272,000.
Who do you blame for all of this? Do you blame yourself or the credit card companies?
Well, I can't blame the credit card companies for spending the money because I actually did that. So I would put 70% of the blame on my shoulders. However, the ease with which I was able to get that credit made my situation worse as we went along. So I would put 30% of the blame on them and 70% of the blame on myself.
Despite growing alarm about debt levels, in 2005, the Bank of England cut interest rates yet again.
Faced with evidence of a slowdown in the economy, the Bank of England reduced rates by 0.25% to 4.5%.
Cutting the borrowing rate helped to boost the flagging economy and encouraged a new wave of lending by the banks.
This is when the period you could say was maybe the nutty lending period, where because house prices had risen so far, most of the loans on their books were absolutely rock solid. So at the extremes, they could have some really quite silly lending, offering extremely high loans of up to 125%.
It seemed low interest rates and rising property prices were here to stay, and bankers began to take bigger risks. Mortgages were sold on as financial products. But when homeowners in the US defaulted on the original loans, the house of cards tumbled. By the summer of 2007, the game was up.
At the beginning of August, we put out a note that was called The End of the World as We'd Known It. What had just happened was that a lot of that structure that had been feeding banks for the past 10 years, really, had begun to really just stop.
Frightened of their exposure to huge losses, the banks froze. The whole system of global finance collapsed, and a new phrase was born.
As we barely know which banks are affected, and as no one wants to buy parcels of debt anymore, the easy lending days have gone. Banks are being far more cautious. It's what they call a credit crunch.
Over the last year, banks and other financial institutions have been hoarding cash, reluctant to lend to each other and reluctant to lend to us. And not only are they cagey about new borrowing, they're calling in old debts as well. With over £50,000 owed on loans and credit cards, Anne and Nick have turned to their local Citizens Advice Bureau for help. They've set up a plan to make their repayments more affordable However, one lender isn't happy about the arrangement.
We set this plan up about 3 months ago, I believe, and most of the creditors have been fine, but we have one creditor who is hassling us, really I'll come back to you to find out what we do next.
Yeah, and what sort of things are they saying to you?
Well, now we're getting letters threatening court action and knocking on the door, bailiff type thing, and obviously that's very worrying and very concerning.
This is something which is happening more and more, as in fact more people are finding they are getting into debt. The problems on the banks are increasing. They're becoming much harsher and much fiercer in trying to persuade people to pay up the debts. They know that they can't get much back through the courts, and the only way they can be sure of getting some money back is to threaten you at this particular stage.
Most of Anne and Nick's disposable income is now going to their creditors, leaving them with just £100 a month.
We don't have a life. We can't spend any money. If anything goes wrong or breaks, we're in problems. We have no money to pay for things.
For them and the 600,000 other people who've signed up for debt management plans, life without access to easy money has changed dramatically. But what if you're still looking for a loan? To find out how the credit crunch has changed the lending landscape, I've enlisted the help of 3 young borrowers. Solicitor Natalie Berman has 4 credit cards which she's used to fund holidays and a taste for designer fashion. Her sister Verity and friend Lydia are both saving for a deposit for a mortgage. Money expert Michelle Slade has studied our group's personal finances, and she's about to reveal how the credit crunch will impact on their lives.
Mortgage rates have gone sky high, credit cards have gone up, loan rates are at their highest rate in 7 years. So consumers just need to make sure that they shop around to get the best deals.
Natalie recently consolidated her debts into one loan, but she hasn't cancelled her credit cards. And that could mean being turned down for other loans.
Well, the lenders have really tightened up on the credit scoring. Now they're really sort of looking at who they're giving their money to. So looking to cherry pick the best customers. And if you've got existing lines of credit open to you, they'd rather you would use those than actually give you further lines of credit.
Natalie could even be penalised for not spending on her cards.
Some of the lenders have actually been bringing in fees for low usage. So even if you don't use your card, you may actually be stung with a £20 fee. So, it's worth sort of cancelling them to do that, yeah.
However, for these young women, it's the mortgage market where the credit crunch hits home. The amount needed for a deposit has risen from 10% to an average of 20%.
So you've got to double your deposit. How much more do you need to save on your deposit?
Well, I guess at least kind of 10 grand more.
For Verity, the youngest member of the group, the end of easy money means more years of living with mum and dad.
Well, I'm just using it as an opportunity to save up some substantial savings to put towards this gigantic deposit that I have to achieve. I have to be realistic now, and 20% is what I'm looking for. So I do have to stay at home and, be a bit more sensible these days.
At least these young women can still hope to borrow, even though the banks have raised the bar. But for a growing number of people, the credit options are running out. Over the past 6 months, 2 million personal loan applications have been turned down. 3 million credit card applications have been rejected. Banks are just keeping their money locked up. For some people, borrowing isn't just more expensive, it's impossible. So where do you go if you need credit, but the high street lenders have shut the safe door? Jo Manning may be able to help. She's one of around 11,000 agents working for Britain's biggest doorstep lender, Provident Financial. While many high street banks teeter on the verge of collapse, the boss of Provident says it's developed a winning formula.
Our business model is largely unchanged, really for the last 125 years. What we provide is small sums of credit that are provided by an agent who will call on you at home, and then we'll come back on a weekly basis to collect the repayments.
Today, Jo is visiting Gaynor Davis, one of her regular customers.
Hiya, Han. Hiya, all right. Good, yeah, no problem.
She's taken out a £1,500 loan to help pay for her wedding. The loan repayments are £45 a week for just over a year.
Shoes. All right, how much are you paying this week?
Yeah, the full amount, please, for this week.
So that's a total of £2,520, or an equivalent APR of 56%.
I was going to ask you actually, Jo, if it's okay, where I've nearly paid off the wedding loan,
if Provident would consider the possibility of borrowing some more around about Christmas.
Let me know nearer the time when you want it. We'll have a look at the book and we'll go from there, but I can't see a problem being with that. I'll see you next week then. Yeah.
Provident says its premiums reflect the costs involved in operating a face-to-face service for its 1.7 million customers, many of whom have low incomes or bad credit scores.
If you feel that your circumstances are changing, you can have a conversation with your agent, and in that conversation you can come to an arrangement to make a reduced payment or even miss payments for a while. And the important thing is that if that happens, there are no late payment or any other fees associated with perhaps dropping into arrears or making reduced payments.
However, some critics say borrowers should be wary of this form of credit.
Some of the concerns with doorstep lending is that it is quite expensive for households. It's the most expensive form of credit. Consumers might not realise that they could go to somewhere like a credit union and get a very similar deal with a similar credit history for maybe 1/10 of the cost.
Back in Devon, Bruce Eyre is looking to another credit crunch growth industry to relaunch his career.
Hello, Bruce.
He's now a debt advisor. With over £250,000 owed to his creditors, he says he's well qualified.
I've got the empathy with people. Well, you actually see it on their faces when you say, well, actually, I've done that, or I'm going through that. They go, oh, there is somebody else out there who's in the same situation as me.
There'll be no shortage of people for Bruce to comfort. Another 40,000 have gone bankrupt this year, and home repossessions are running at over 100 per day. The continuing financial crisis and the credit crunch have signalled an end to a decade of laid-back lending, years which have redefined our attitude to borrowing.
My bills are all due, and the baby needs shoes, and I'm busted.
I think the credit card companies created the kind of products that made us feel good about debt, which in fact, you go down the pub and people talk about how maxed out their credit cards are now. There's no shame in it at all now.
As the credit dries up, many are now adjusting to life without easy money. Analysts who've studied our spending habits say that means a reality check.
What we discovered was the bottom 40% of UK households had negative cash flows, i.e. they didn't make their ends meet. Now, a year ago, that wasn't a problem because you could get that extra credit card or you could get that 130% loan-to-value mortgage easily. Can't do either of those things nowadays.
I was just thinking about calling on you and I'm busted.
The banks are now counting their losses, but we're all paying for the risks that they took. Living on borrowed money may soon be a thing of the past.
If you're at all risky, you're going to find it very hard to get credit because the banks are now going to be saying, the last thing I want on my books is another risky person who might default. If there's anything dodgy in your credit history, if you're young, if you need to borrow a lot of money, it's actually going to be your income that will determine your spending in future. You will not find it so easy.
Next week, I'll be investigating the property market slump.
Repossessions are rising, mortgages are getting more expensive. Is it really worth buying our own home?
We've done the sums to find out.
I suspect it'll surprise quite a lot of people.
Are bricks and mortar still worth investing in, or is renting the way forward? Find out next week.
Remembering when a global financial crisis led to dark times, the Wall Street crash and the Great Depression of the 1930s in the People's Century, tomorrow night at 9:50 on BBC 4. A first for Autumn Watch next here on BBC 2, a live dive for conger eels.